The markets are scared right now. People are worried about what's going to happen. There's a lot of uncertainty in the air, and people have been looking to value to protect their assets. But today, I want to give you a contrasting opinion because I think this is the perfect time to start looking at some of these riskier, smaller cap companies in order to supercharge your portfolio and maximize your risk return potential. In this video today, I'm going to be talking to you about a strategy that I use personally in my portfolio in order to give myself the best chance at compounding growth over time without risking too much of my overall portfolio. If that sounds interesting to you, please do subscribe to the channel. It means a huge amount and doesn't cost anything. So let's get into the video. Let's talk about what exactly is it that I mean. Why am I recommending small caps at a time when things are so uncertain in the economy? And what do I think individual investors should be doing right now with their stock market investments? The first thing I want to show you today is something called the AAII Investor Sentiment Survey. Now, the AAII stands for the American Association of Individual Investors. It's a US-based association that talks to retail investors about their sentiment in the markets and all sorts of other things. This survey specifically shows us if they are bearish, bullish, or neutral. So bearish meaning I don't like what's happening, bullish obviously I'm happy, neutral, and gray in the middle. And you can see it here on the screen. And I want to direct your attention down to the very bottom of this chart because it shows us that right now, the week ending on the 15th of January 2025, which is the most recent data we have, is the most bearish investors have been over a year. Through all of the drama of the last year, this week is the most bearish investors are. And you're seeing that uncertain or neutral number massively up. Now, we're not quite at the 52-week high, but we are quite high up in that sort of neutral area. We're pretty close. We're about 2% off of what the 52-week high looks like. And our bullish number obviously is tiny at just a quarter of investors feeling bullish on the market over the next 6 months. And what is this going to reflect in the markets? Well, it's going to reflect investors fleeing to safety. They're looking for a place that they can put their money to protect it, to avoid losses, and to put themselves in a better position regardless of what happens. And so a lot of these investors look towards what we call value stocks. Now, if you're watching this, you know what I'm talking about. We're talking about a McDonald's, Procter & Gamble, Coca-Cola. These are stable companies. They have a proven business model. They're profitable. That's like the golden recipe of a stable value stock. I think investors are wrong though. I think instead, investors should be looking for the discounts that people are leaving on the table. Right now, people are selling risky, unprofitable, debt-riddled companies in order to buy proven companies. But as they flee from these risky companies, there are going to be gems left behind at discount prices that I think are really, really worth looking at. Do I have any specific recommendations for the next couple months? Not yet. But I do have a couple of examples of what exactly I'm talking about. First off, this is probably the most famous small to now mega cap company that we've seen in the last couple of years that was struggling, was unprofitable, investors had sold down and suddenly rocketed upwards, had probably the best year of any stock I've ever owned. I'm talking about Palantir Technologies. If I toss up the 5-year chart for you guys, you'll see that Palantir Technologies rushed up from its IPO. It played really well over the sort of 2021 hype era, I'm going to call it. And then it sort of faltered. And as 2021 sort of ran on, we see it just slowly slide down into this single digit range. Now, in this single digit range, as 2022 came to a close and 23 went on, I started looking at this company. And I saw that investors had told me that they're never going to be profitable. Their ideas aren't great. This is a government company. It's got a crazy PE ratio. People were telling me how this was not a good value play. How, it was being overpriced and it just wasn't something I should look at. And I said that actually I thought that this company was in a beautiful position to take advantage of the now up and coming ChatGPT, the new AI craze, it was in a great position, and we have all these geopolitical tensions. If you think about what happened throughout 2022, obviously there's a major war that began. We've got tensions in the Middle East, tensions in Asia. A company that does defense contracting and also does AI with corporate players sounded pretty beautiful to me. So I invested. And crucially, I invested a tiny sum of money. I invested about 2% of my portfolio, which honestly at the time was probably not more than a couple $100. And I sat on it and I waited. And in May of that year, I saw things go much better for me. You'll see in May, we see the price jump up to about $15. I was overjoyed. I thought I had done such a great job. I doubled my money. But I still sat on that play because I only made a couple $100. It hurt nobody to let it ride. See what happened. This company was showing great growth. Things were looking up. And if you look at the macro trend from about the start of 23, you see things are just slowly growing and growing and growing. Then 2024 comes around and oh my gosh, did this company have a great 2024. Walked into the year sitting at about $17. And throughout that year, we see it rocket up to a peak in the 80s. That is a fantastic move. And it showed more than a 10x of my initial investment, which again, only a couple $100, but now was sitting at, almost 20% of my overall portfolio. Not quite because other things had grown, but that maybe 2%-ish had massively grown. And this is exactly the kind of strategy that I'm talking about here in this video, because by picking what looked like a, questionable small cap company that was in trouble, maybe that hadn't figured out how exactly it was going to make profits and letting it ride, I had made my portfolio grow by over 20% overall with just that small amount of money. Now, could I have invested more and made more money? Absolutely. If I had put 100% of my portfolio, I would probably be on a beach somewhere. But I would have had to risk everything I had. And the biggest thing about compounding is never to interrupt the process. That wasn't something I was willing to do. Lots of other companies in my portfolio have grown awesome as well. And this is the exact strategy that I'm talking about. I'm going to come back to the camera here. I really do want to talk just directly to you guys. This is my strategy. I am a pretty conservative investor. I like to sort of play it safe. I own a lot of financials. I own indexes. I own, big growing dividend payers, which are usually profitable companies that have really figured out their business model. And particularly in the Canadian market, we have a lot of those companies. A lot of our small caps aren't interesting tech plays, but instead are maybe TSX venture companies or small resource companies that have massive risks associated with them in return for massive reward if and when it plays out. But I found that if I'm willing to look just at the small cap market in general, that there are some really interesting stories out there that can massively increase over time. You let it ride, you'll see it become a huge part of your portfolio, and you'll massively supercharge your total investment returns with just a small amount of capital. And I think right now is the ideal time to follow this strategy. This is what I'm going to be doing over the next little while, looking at companies that are catching discounting alongside all of this instability, right? So companies that might have required interest rate cuts in the US that didn't come, companies in Canada that are going to be damaged by the potential trade wars, all these kinds of companies that have a fear around them, right? Where investors are leaving because they believe that something is going wrong. But they have to be a couple important things. They need to be companies that I believe in for the long term. If you're trying to swing trade small cap stocks at a time when uncertainty is at its peak almost, or at the very least at the peak of the last year, you're probably going to make a mistake. So you need to believe in the company. I don't want to see people out there that are just risking money because they think, oh man, this could go up for 6 months. You want to believe in that for 6 years, because you might be in a position like I was, where that company doubles up. And if you don't believe in the company, you're going to sell. You're going to sell right there and then. And yeah, you'll have made lots of money. But if you're only investing a tiny little part of your portfolio, you're not going to see the kind of returns that would actually change things, that would actually move the needle for you. Instead, you got to let it ride. There are so many great companies out there that haven't quite figured out maybe their profitability, that haven't figured out how to scale, that haven't figured out how to adapt to a change, or that haven't managed to convince investors that their idea is worth buying. And it's time to go look for them. That's about all I have for you folks today. I hope you appreciated this video. If you enjoy this kind of content, you want to talk more about investing, specifically Canadian investing, please do subscribe to the channel. It means a massive amount, doesn't cost anything. And if you enjoyed this video, you made it this far, please do like the video. It means a huge amount to us here, and it definitely helps the video in the algorithm. And with that being said, I hope I see you in the next one.